Hey guys, so this is the part 2 of a 2-part video about diversification. If you haven't already watched the first video, I recommend doing that first. So that was more about what is diversification and just the basic principles behind diversification. In this video, I'll talk a little bit more about how you can go about diversifying a portfolio and some of the different asset classes or different things you can think about when you're looking to get diversification. So I think beyond just wanting to have 5 or 6 different investments to help get a more stable portfolio return over time and minimize volatility and drawdowns, diversification's not just about having multiple investments, it's also about trying to find investments that are uncorrelated. So by uncorrelated, I mean assets and investments whose prices go up and down at different times and have cash flows that are driven by different fundamentals. So a good example might be if you're heavily invested in property, but you want to diversify your portfolio by investing in stocks, you wouldn't get a lot of diversification if you were to turn around and buy bank stocks, because typically you find that a lot of the banks make their money from lending to homeowners or property investors. So if there's a downturn in property, you'll often find that banking profits and revenues and those sorts of things come under pressure as well, which will often see their stock prices fall and their cash flows reduce. So in that sense, that because their business models are similar or they're related, you might find that they're very correlated, and so you're not getting that diversification across your portfolio if you're invested in both of those 2 asset classes. So you might think, okay, well, you might want to invest in some industrial stocks, or you might want to invest in some supermarkets or utilities or something else that's a little less correlated to the property market. It would be the same for probably investing in construction companies or a real estate agency that's listed on the stock market. It's like you're looking to, so the objective of diversification is trying to have assets going up and down at different times to minimize the drawdowns and ensure that you have cash flow coming in throughout the cycles to allow you to take advantage of those asset price falls, because the best time to invest is when prices drop, but you need to have cash on the sidelines or cash flow coming in to take advantage of those opportunities. The next thing to consider is that if you're, for example, Australian, as I am, if you're invested in property and you're putting money to work also in the stock market, is that you also then have a portfolio that's heavily concentrated on the Australian dollar. So you might sit there and think, oh, okay, well, I'm very heavily invested in the Australian economy and on the Australian dollar, so maybe you want to have a position in your portfolio that does well when the Australian dollar goes down. So you might be looking at exporters then, or you might be looking at investing in property stocks or properties that are overseas and trade on foreign markets, so that you have a bit of a currency hedge as well and get a bit of diversification from currency movements. So in Australia, some examples of some exporters might be agricultural companies or companies related to tourism, or companies that might be a gold miner or an exporter of manufactured goods. So you can start looking at different types of companies to have exposure to. And often what you'll find is that when there are particular sectors of the economy that are doing really well, you find that most investors tend to pile on and chase the trend, in that often when you try to diversify your portfolios, when you can find some of the best value companies, because a lot of them are unloved because they haven't been doing really well and they trade at really cheap price to earnings or enterprise value to EBITDA ratios, and things that as an investor you want to be looking for naturally. So trying to diversify your portfolio is almost like hunting for undervalued investments. You're just looking for ones that perform differently than the ones that you're currently concentrated in. In addition to that, diversification can be really important when you're taking on leverage, and whether that's leverage in property or taking out margin loans for stocks. as I spoke about earlier in the previous videos, that when you're leveraged, prices can go up and down, and if you are too leveraged, you might find yourself forced out of the market just to pay your debts, as in creditors might want to recoup those assets to cover the loan that you took. And so sometimes when you use leverage, you can even be right about the fundamentals of a company and an industry, but if you get the timing subtly wrong and you're using leverage, you might find yourself forced out of a position if you're in an undiversified portfolio. So an example of this might be, Apple came out with their iPhone in 2007, or their first iPhone, and you might have been, certain that, oh wow, this is a game-changing product and everyone's going to buy this and Apple's going to become a really great company in the future. And you might have bought Apple stock in the middle of 2007 once you'd realized this, and you decided you wanted to get really aggressive on that investment. If you just invested in Apple stock and you'd leveraged yourself 2 to 1, when the market turned down in late 2008 with the whole market, Apple stock fell by 50%. And so if you'd had an undiversified position, you may have found yourself being forced out of having to sell your Apple stock to pay your debts when you were completely right about the company and the product. And from the bottom, from the Apple stock's low in 2009, it's gone up tenfold since then, but you would have got shaken out of the market and wiped yourself out because you coupled leverage with an undiversified portfolio. Whereas if you'd had a couple of investments that were uncorrelated to stocks or less correlated to stocks, and you may have found that that downturn would have been less severe. You might have only had a 20 or 30% pullback and been able to hold your Apple position because your conviction was strong, and you would have been able to reap those gains over the next 5 to 10 years. So an example of that uncorrelated assets might be, you could look into things like US Treasuries or cash itself or gold, or things that sometimes or often have a negative correlation to general stock prices. So diversification is a way of reducing those volatility, and when you have large volatility, debt becomes dangerous. So sometimes when you're using leverage, you want to make sure that you're also implementing things that can help reduce your volatility. Another example of where a diversified portfolio can come in handy is if you, say, were really bullish on US airlines in the early 2001, before the 9/11 event, you might have been buying those companies thinking that it was a good industry and going to produce good cash flows and had a future. But when 9/11 happened, the whole sector dropped away by 30-40%, and that would have just massacred your portfolio. And if you had leverage, you could have been in a lot of trouble. And whereas if you had a bit more of a diversified portfolio, if you had 4 or 5 other positions, you might not have found it was as big a deal. You might have had a couple of companies that did quite well irrespective of that event, or maybe even profited from that event. And as a result, the advantage of having that diversified portfolio is if you're bullish on the airlines but they go down and you have another asset that goes up as a result of that, sometimes you get in that position where you start to look at, oh well, this asset now might be a little bit overvalued and these are really cheap. I like these assets, the airlines, 6 months ago before this event, and they're now on fire sale. You can sell some of these overvalued assets or assets that have gone up in value and buy the companies that you originally liked at a depressed price. And so you're selling high and buying low, which is the theory behind investing. And having a diversified portfolio is what gives you that ability to do that. And there's just so much information out in the market that it's hard to know everything about every company or every industry. So making sure all your eggs aren't in that one basket can really save your portfolio and create opportunities for you. So one of the important principles behind diversification is not only just having different companies that you've invested in, but trying to invest in different asset classes and different industries within those asset classes, as a lot of asset classes will also sort of have subcategories. So for example, some of the broader asset classes can be things like, property, stocks, bonds, commodities, precious metals, or alternative investments, like small businesses or small art, or other niche investments. But then even below those industries, like, there can be good and bad investments in any given industry. So you might want some exposure to bonds, but you might think government bonds are overvalued, but corporate bonds are really good value right now, or vice versa, or junk bonds are really cheap because people are worried about, I don't know, an oil price collapse or something like that. And the same within properties, that you can sit there and go, well, residential property might be booming, but commercial properties, not doing so well, or industrial property is not doing so well. And so you can sort of get some property exposure, but you can get it specific property exposure because you're still looking for good value. You're not just looking to just throw money across a broad spectrum. You're trying to find good value assets in every asset class that hopefully aren't too correlated, and do some research and maybe do some back testing to see how correlated are those assets. So some other examples of some diversification might be domestic stocks versus foreign stocks. So if you're in the US, you might want to invest in some money right now in some emerging stock markets, because your stock market has gone up over 200% in the last 7-8 years. So you sit there and go, okay, maybe it's time to take some money off the table, and there's some stock markets out there that are still quite depressed. Or you can look at developed markets versus emerging markets, or you can look at gold versus silver, importers versus exporters, trying to make a play on currencies, or diversifying yourself around different business models. And as you get more experience investing, you can even start considering things like going short and long. By that meaning, betting against the market and betting on companies, in the sense that you can make money when the stock market goes down as well as up. Because often when you're reviewing companies, like, a lot of people are looking for good investments, but as you become good at finding good investments, a lot of the time you'll read annual reports and look at other companies, and you start to realize what is a bad investment. And sometimes there's probably more money to make betting against the company than betting on companies. But shorting stocks can be, well, that's a topic for another video, and it can be a little bit expensive, and it's got a little bit more risk to it potentially, especially these days. But I'll talk about that in another video. But so the point of diversification is you're looking for uncorrelated assets that help stabilize your returns over time. And so, like, the holy grail of investing is risk-adjusted returns. And so people have different ways of measuring that. And like, a popular one is a Sharpe ratio. So where you're trying to get growth slowly and minimize these downturns. So that's what we're all hunting for in the investment world. And I think that most people would want to achieve the same. But beyond that, I think a really important thing to realize about investing is that you don't want to be too diversified, in the sense that if to be a good investor, you need to be making informed, unemotional, rational decisions. And the more positions you have within your portfolio, or more investments you have, the more you need to know about a specific industry, specific company, or countries. And so that can become rather onerous in terms of time and knowledge. And so my personal view on investing is I keep about 5 to 10 positions at any one time. I try to keep them semi-uncorrelated, and I'm looking for good value at all times. And I'm trying to think, where the market will be in 2 to 5 years' time. But the point is that I need to keep that portfolio small enough that I can stay across it, so that if something changes, I can sell quickly. Keep an eye on a number of other potential opportunities of companies that I like, but I think might be a little bit overvalued right now, and I'm sort of waiting for a better buying opportunity. So there's this time you need to invest in both the companies that you're already invested in, but also the alternative options that you have out there. So it's hard to know if you've got a good value investment if you're not looking at your alternative options. So you don't want a too broad investment portfolio, because that just takes up too much time and energy, and makes it difficult for you to beat the market. And I mean, once you start investing in more than sort of 30 or 40 companies or stocks, or any investments, you start to get more of a market return rather than a portfolio return, and your ability to beat the market diminishes as you get more investments in your portfolio. Yeah, and I like fundamentals of investing is to buy low, sell high, and it's just more difficult to do that if you're trying to do it across lots and lots of companies. It requires a lot more time and energy. All right, well, I hope that helped give you an idea about what diversification is and how you might go about it and some of the things to think about when you are trying to diversify your portfolio. If you have any questions, put them in the comments below and I'll address them in a future video. Otherwise, I'll see you in the next video. Thanks.